Hi. In this part of Chapter 1, we will talk about accounting in general. What is accounting? What does it involve? Who are the users who benefit from it? Why would we care or why should we care about accounting? First, what do we mean by accounting? Accounting is the language of business. And why do we call it like that? Well, because it gives a picture of the financial situation of the company. Basically, accounting is an information system that captures economic events for a certain organization, and it communicates this information to those stakeholders who actually can utilize it and can take advantage of this information. For example, an investor who is considering two companies for investment can utilize their financial statements and financial reports in order to compare their performance, and then that investor can decide which one would be more profitable or less risky in order to invest and make the final decision which one to invest in. Without such information, the decision would be random. Company A or company B, it wouldn't matter. And at that point, it could be even split 50-50. However, this is not the optimal solution. Whereas using accounting information would enable them to get a better informed decision, to make a better informed decision. Now, another example is when a company introduces a new line of product. Take Apple, for example. When they want to release a new device, how do they decide on how many units they are going to manufacture? Are they going to produce 10 millions, 15 millions, 5 millions? Let's say that the market actually needs 10 millions. If they produce too little, say 7 million devices, they will run out of stock. They are short of more or less like 3 million units. By that, they might even lose the clients who might switch to a different device rather than wait for the amount to be remanufactured later on. On the other hand, if they produce too many, they will end up with millions of devices sitting in their warehouses, not being sold or not being used. That is also a loss. So how do they reach the right amount? How do they make the right decision? Well, they can predict how many units they need to manufacture by looking at previous year's accounting information, such as sales. If they look, for example, at how many devices were sold when they released a new iPhone in the previous years, they can make an estimate, a pretty accurate estimate of how much they also need to manufacture this year. No matter what, such a decision would be much better than a random decision. It would be a better informed decision based on accounting information. Now, the main purpose of accounting is to identify, record, and communicate financial information about economic events. Now, this is the main purpose of accounting. It has 3 steps. First, we need to identify the records of interest. In other words, the events that can be thought of as an evidence of the occurrence of an economic activity, such as a sale, a purchase, or a payment of a bill. Now, once we have identified those records, the next step would be to record those events. Accounting helps us keep a systematic and chronological record of events. It's more or less like a history or a diary of events that can be measured in dollars or other monetary units. Now, bookkeeping consists of this second activity. In other words, it's the recording phase of economic events, and it is, as a result, it can be thought of as part of accounting. However, it's not accounting in general. Accounting consists of the 3 steps. Now, once we have identified the records and the events that are interesting to us as accountants, and once we have recorded them, well, they will be of no use if they just reside on our servers. Instead, we need to communicate this information to the various users who might be interested in such information. For example, you can produce them in the form of financial statements and publish them online, and in that case they can be used for investors and creditors, etc. Now, accountants, they also possess the ability to analyze and interpret the recorded events. So it's not only that they need to communicate the information, but they also need to educate the users on how to analyze it and how to make use of this information. So they usually communicate such analysis in the form of ratios, percentages, graphs, patterns, outlier reports, and in that case they give the user an explanation of what this reported data means and how it can be best used, as well as any limitations associated with that information. The most common form of reports that are known in general are the financial statements, which usually include data that is reported in the aggregate, and by that we mean it's not at a very detailed level for convenience purposes. When we think about accounting information users, basically we think about two main categories. Those could be internal users or external users. Basically, internal users, they use the accounting information to help them make managerial decisions. These decisions, they include, for example, the price the company would want to sell a new product and at which price would maximize the company's income. Another question that that internal users try to answer using accounting information would be, for example, can we afford to increase the salaries of our employees? Can we distribute dividends to our shareholders? For that, they usually need detailed information and detailed reports, which are usually provided by managerial accounting. Now, examples of such internal users include HR, company officers, you have marketing, the finance department, etc. On the other hand, external users are external parties that are not part of the company, and those they might have different interests. Therefore, it becomes somewhat hard to provide reports that satisfy all their needs. As a result, financial statements try to best satisfy these users as much as possible. It's more or less like one size fits all. Now, external users such as banks, lenders, basically we have also tax agencies, governmental agencies, investors, customers, suppliers. All these, they attempt to use these reports, usually the financial statements, in order to answer questions that would be like similar to, for example, will the company be able to pay back their loans or will they default? How profitable is this company? Should I go with company A or company B? What about for example, the income of this company, etc. There are three major areas in accounting. You have tax accounting, managerial accounting, and financial accounting. Tax accounting, talks about policies, tax policies, etc. And those policies are determined by the government. Such policies are not only affected by the economy, but also by politics. And in certain cases, the managers of firms, they try to, or even sometimes individuals, they try to minimize tax payments without breaking the law. So what they do is they report their income for tax purposes, and they try to minimize their income that is reported for tax purposes in order to pay the least amount of taxes possible. That is without breaking the law. In this course, we will not be talking much about tax accounting. We'll be focusing about financial accounting. Now, managerial accounting is, like we mentioned before, this is used by the management, used by companies' management in order to, and by other internal users in order to make decisions and to make the right decisions. Usually, this is not as strict as external reporting or financial accounting because it depends on every company. Every company basically has the right to choose their own procedures and to basically within the company, and they can decide on which kind of reports they want to have. Additionally, usually those reports are much more detailed because they would require more information in order to make their decisions. Plus, it's usually timelier and than the regular financial reports that are filed for external users. Finally, we get to financial accounting, and this is the main, this is the focus of this course. This is where the main focus, the importance here is to make this information available for external users in a standardized way in the form of financial statements, and to make sure that the information is reliable, credible, and comparable across all across various companies. Hi. In the second part of chapter 1, we will talk about the building blocks of accounting. Basically, we will start with discussing the importance of ethics in financial reporting. And then we will talk about the various government agencies and organizations that are involved in setting accounting standards. More specifically, generally accepted accounting principles, or GAAP. And US GAAP are the standards that are to be followed by companies in the US. Finally, we will discuss two measurement principles and two assumptions that provide the foundation for the accounting process. So to start with, why is ethics important? Basically, ethics is standards against which our actions are judged as right or wrong, honest or dishonest, fair or not fair, etc. Now, again, why is it important? Let's say that I am a gambler and I have doubts that the casino is cheating. Do you think that I will continue to gamble in that casino? Probably not, because I don't trust the casino itself, and I have doubts that no matter what I do, because they are cheating, they will beat me and basically they will take my money. Well, the same thing applies to investing in companies. Let's say that investors lose faith in the stock market. Who will invest anymore? Who will buy stocks in for any company? For example, let's say that two companies, that you know that there are two companies, one of them is cheating, but you don't know which one. Now, you will not be taking into consideration any of the two numbers. You will either simply invest in either of the two companies, or you will not invest at all. As a result, why would that happen? Simply because I don't trust the numbers, so I don't know which numbers to trust, and as a result, I will not be trusting either statements, either from company A or company B. In such case, I will not invest at all. And if all the investors follow my lead, at that point, the stock market will collapse. Another example could be, for example, eBay versus Craigslist. You can safely send money and pay and send money because you can use PayPal to another eBay user even before receiving the goods, as you have faith in eBay itself and in PayPal. Now, on the other hand, Craigslist themselves, they urge their users not to send money or to wire their money before they actually receive the products, because they cannot guarantee that the other party are not scamming or they are not fraudsters. Now, in the early 2000s, there were several accounting scandals, most notably Enron and WorldCom. As a result, the US government, they responded by passing Sarbanes-Oxley Act of 2002, which is also known as SOX. Now, the reason why they did that was to reestablish trust in the stock market, to basically increase or improve monitoring and internal controls, to increase the independence of auditors, increase liability and responsibility of management. As a result, the accountants now are expected to follow certain standards in financial reporting that are stricter than before. When we talk about accounting standards, there are several organizations and government agencies that are involved in setting standards. The SEC, or the Securities and Exchanges Committee, that is the entity that oversees all financial markets and accounting standard setting bodies. It was set up in 1934. Its main job was to require that investors receive significant information about securities being offered to the public and to prohibit deceit, misrepresentations, and other frauds in the sale of securities. Now, the SEC relies on the FASB, or the Financial Accounting Standards Board, which is a private body consisting of market participants that sets the standards for disclosures, later on to be mandated by the SEC. So the SEC basically relies on the FASB to formulate those standards, and then it mandates them. The PCAOB was created by SOX to oversee audits. That's the Public Company Accounting Oversight Board. And the International Accounting Standards Board is similar to the FASB, but this is the international. It formulates the International Financial Reporting Standards, also known as IFRS, which are the guidelines that are mostly used outside the US. So US GAAP are the standards that, or the guidelines that companies need to follow when they report their financial statements in order to satisfy their information users and to comply with the regulations. It makes it, because of the standardized type of reports in the form of financial statements, that would make it easier for the user to use such information in order to compare the performance of various companies. Now, the difference between US GAAP and IFRS is detailed in the book. Basically, US GAAP are the standards used by public organizations in the US, while IFRS, or International Financial Reporting Standards, are used by public organizations outside the US. There's a trend recently of minimizing the gap between US GAAP and IFRS, and as a result, this is what they call convergence. They are trying to make the differences kind of a little bit, they're trying to minimize the differences between the two types. The main financial statements that are reported and filed by companies are the balance sheet, income statement, statement of stockholders' equity, statement of cash flows, and footnotes. As we mentioned earlier, we will be talking about two measurement principles. So we have there is the cost principle and the fair value principle. The cost principle, or the historical cost principle, it states that assets and liabilities are to be initially recorded at cost, and they have to remain at cost until they are sold, consumed in operations, or disposed of. So basically, if you buy a land at $5 million, initially you recorded at $5 million, that was the cost. and then every year you keep recording it until it is sold, or if it was supplies or something like that, until they are consumed. Now, even if that would be the case, even if, for example, in 2 years the value of the land became $7 million, you still record it at cost. And under GAAP, this is the principle, or this is the measurement principle that has to be followed, except for specific assets. On the other hand, fair value principle states that assets and liabilities are should be initially reported at cost, but then each reporting period, any changes in fair value must be recorded. So this is mostly useful for assets where the information can be easily accessed or easily available, such as traded stocks or securities, because you can simply go online to the stock market and you can download this information, or you can obtain the market value of these assets, compared to, for example, a land where you would need to find the information. In order to find the fair value, you need to get an appraisal, which is by itself subjective, and moreover it is costly, especially if you have a lot of assets, and in order to evaluate every one of them, it will become very costly for companies. Now, under GAAP, as we mentioned, it has the assets must be always recorded under following the cost principle, except for, like we said, securities and stocks, etc. Those two, like basically the selection between those principles, it also depends on the relevance, which is to mean whether this information is relevant and it would affect my decision making whether to invest in a company or not, or whether to give that company loans or not, as well as faithful representation, which also which is basically how well these numbers, they reflect the reality of the company. So as a result, there's a trade-off between the two. Now, the two assumptions that we will discuss are very important for accounting to work properly. The first assumption is the monetary unit assumption. Basically what it states is it's simply that any event we must be able to express it in monetary value in order for us to record it. In other words, a transaction has to be expressed in a dollar amount in order for it to be recorded. Now, this is very important for the cost principle. In order for it to work, you must be able to assign a monetary value for any transaction that you record. However, that also leads, unfortunately, to the loss of certain qualitative information, such as the quality of services provided by a company or the health of a CEO, etc., which can have an effect on the company's stock, but it is hard to capture and to compare or analyze. Basically, the monetary unit assumption enables us to quantify the information, and as accountants, it's much easier to work with numbers and to analyze them than with qualitative information. Plus, qualitative information can be very subjective compared to the objectivity of numbers. The other assumption is the economic unit assumption. And here, basically what we're saying is that any economic entity, the activities of such economic entity must be kept separate from the activities of other entities or of the owners of that entity. And when we talk about economic entity, basically we're talking about any company, government agency, municipality, city, university, etc. So all these economic entities, they have to keep their transactions separate from those of their owners, as well as from the activities of other entities. And usually usually companies or businesses, they take the form of proprietorship, partnership, or corporation. Now the differences between these three are listed in this table. Basically, a proprietorship is a business owned by one person, usually small businesses that provide services such as uh, plumbing services at the deli around the corner, etc. And those, they have limited life because they depend on their owner. All the profits of the business, they would go to the proprietor or to the owner of the business, and all the losses are endured by the owner as well. And here we talk about unlimited liability, because if the business goes bankrupt, the liability of the owner extends to their own to the owner's personal assets as well. Now, partnership is very similar to proprietorship. However, it is owned by two or more persons, and those are the partners. And there is usually a partnership agreement that would govern that would govern the what happens in the case of the death of the partner, or what happens when the partnership is to be dissolved, etc. If one of the partners decide to sell his or her share, usually that is explained in the partnership agreement. And once again, partners, they take the profits and they endure the losses of the business. Once again, here they are, their liability is unlimited. So basically, proprietorships, they have there's no legal distinction between the owner and the business. Now, although there is no legal distinction between the two and their liability is unlimited, there are still the activities and the accounting records of the owner must be kept separate from the business's activities and records. Corporations are the ownership of these organizations are split into a certain number of shares that are easily transferable, and as a result, the life of these corporations is said to be indefinite, because it's not affected by the death of the owners, which are also the shareholders. And this is usually, it's a separate legal entity that we will discuss that in more details in later chapters. And here the shareholders or the owners are said to have limited liability, because their liability is limited to their investment in that company. And as a result, if the company goes bankrupt, they are not liable, and their personal assets are not they are kept intact. Hi, in this part of the chapter, we will be talking about the accounting equation. We start also talking about assets, liabilities, and stockholders' equity, as well as the relationships between all these kinds of accounts. So, the accounting equation is an essential building block of the accounting process in general, and it applies to all economic entities, regardless of the size, nature of the business, or the form of business organization. So whether it was a large multinational corporate or the deli around the corner, the accounting equation still holds. It provides the underlying framework for recording and summarizing economic events at that economic entity. So it has three major components. Those are assets, liabilities, and stockholders' equity. So assets, you can think of them as economic resources used by the company in order to run their business. Equities are the claims of the owners against those resources. And credit and liabilities are the creditors' claims against these assets. So this is why assets liabilities and stockholders' equity in this form, when we say assets are equal to liabilities and stockholders' equity, basically what we're talking about here, we're talking about what the company owns versus what the company owes. Assets are what the company owns, and liabilities and stockholders' equity are what the company owes to creditors and to owners. And generally speaking, creditors have a stronger claim over the assets than owners do. So in other words, if the company goes bankrupt, creditors get their money first, and then later on, whatever remains is distributed on the owners. Now, assets are basically the resources that the company uses in order to conduct their business activities, such as sales, production, etc. So basically, they are consumed or used in order to generate revenues. The main purpose of assets is to generate, to be used in order to run the businesses, and as the purpose of business in general is to generate revenues, those are, this is when, like for example, when Rutgers, they buy a new building to open new classrooms, which would also, it can be also used to provide classes to students that would generate also revenues from tuition fees, etc. Examples of assets include, but they are not limited to, you have cash, of course, equipment, lands, buildings, inventory, accounts receivable, and those are whatever the company, whatever customers owe the company. When we talk about liabilities, basically we are talking about debts. So these are the claims of the creditors against the business assets. In other words, those are the obligations and debts that the company has to pay. And creditors can be anyone who has lent the company money. So for example, a bank, or in certain cases it can also be a vendor or supplier, where the company purchased certain say equipment or supplies or raw material, and they did not pay in cash. So in that case, they have credit. In this case, the supplier becomes the creditor of that business. They have to pay for that later on. And examples of this also include notes payable, accounts payable, rent payable. This is whatever the company owes to the landlord, or accounts payable, like we said, it's whatever the company owes to their suppliers, for example. Salaries and wages payable, this is the money that the company owes to their employees, etc. Now, the last part, the third component of the accounting equation is stockholders' equity. Well, this is this is the claims of the owners of the company over the company's assets. It is usually, it's also known as residual equity. And the reason we call it sometimes residual equity is because whatever remains after paying all the debts, whatever remains from the assets, that can be claimed by the owners. Sometimes it's also called, by the way, sometimes it's also called owner's equity, sometimes shareholders' equity, etc. So when we talk about residual equity, here we're talking about all the assets, so the total assets minus total liabilities, that would be equal to stockholders' equity. Now, stockholders' equity is divided into two components. You can talk about common stock, and so in this case we talk about common stock and retained earnings. Common stocks are, in general, those are the investments or the total amount paid by stockholders for the shares that they bought. These are the investments in the organization made by individuals or other entities or something like that. Those are not the investment that the company buy in different organizations. So those are the investments that shareholders basically invest in this organization. Retained earnings, on the other hand, is the part of earnings that is not distributed as dividends to the shareholders. So this is the part of the net income that remains in the in the company, and usually companies, they keep this in order to for future expansion or to run the business in the future. And again, it can be computed by subtracting expenses and dividends from revenues. So basically, it's revenues minus expenses minus dividends. Revenues are asset inflows or reduction of liabilities that result from the normal operations of the business. And they affect stockholders' equity due to business operations and business activities. So in other words, these are the activities such as sales, providing services, etc., lending money for and getting interest that the company performs, and they earn money because they earn money from the company's customers because of these sales or services. So you could have, for example, if you're a landlord and you're renting an office, that could be rent revenue. If you provide legal services, that could be service revenue. If you sell TVs, that would be sales revenue. Banks would also have interest revenue. On the other hand, expenses are the cost of assets that are consumed or the services that are used in the process of earning these revenues. And what they cause is they cause a decrease in stockholders' equity compared to revenues, which increase stockholders' equity. So expenses, they decrease stockholders' equity, and those are the costs that are incurred during business operations. They can also include, so those can include services that the company receives, salaries expenses, we have rent expenses, tax expenses, etc. Dividends is the part that is distributed back from retained earnings, so that is distributed back to the owners. So it is very important to note that dividends are not an expense. They are just a reduction of stockholders' equity. Basically, if you owe if the stockholders' equity is $100,000, you give them back $15,000 in dividends. Now the stockholders' equity becomes $85,000. And as a summary of the effect on stockholders' equity, we can see that revenues and investments, they increase. When they increase stockholders' equity, whereas dividends and expenses, they decrease stockholders' equity. So far, we have been talking about the basic accounting equation, and that is assets are equal to liabilities plus stockholders' equity. Now, stockholders' equity can also be divided, as we mentioned before, into additional into more detail, and in this case the expanded accounting equation would break down stockholders' equity into common stock and retained earnings, and then you add also revenues minus expenses minus dividends. This is the one that is usually used when we analyze transactions, and this is the one that we will be using later on in our transaction analysis. Now, as a small exercise, let's see how we can classify the following items. So basically, we need to classify each of these items as revenue, expense, or dividend, and then we need to also look at the effect on stockholders' equity. So interest expense, we know that this is an expense. And expenses, what do they do to stockholders' equity? They decrease stockholders' equity. Sales revenue is a revenue, and as a result, it increases stockholders' equity. Wages expense, those are expenses. And what do they do to stockholders' equity? Again, they decrease stockholders' equity. Stock dividends are, this is dividend, and they also decrease stockholders' equity. This is the end of the third part of chapter 1, and that basically summarizes the accounting equation and the expanded accounting equation. In this part of chapter 1, we will be doing some transaction analysis. We will be using the expanded accounting equation in order to analyze transactions that took place for a certain company. This is a reminder of the expanded accounting equation. Assets are equal to liabilities plus stockholders' equity, and we divide the stockholders' equity further into common stock, retained earnings, revenues, expenses, and dividends. Now, when we talk about transactions, basically what we mean here are economic events that took place at the company. And in order for us to take any transaction into consideration, we have to be able to put a dollar amount to it. As a result, some transactions are not recorded. For example, hiring an employee. This will lead to salary payments, etc. The actual hiring, this is when you sign the contract with the employee, you don't owe them anything yet, so you haven't paid them anything yet, and as a result, this is not recorded as it violates the monetary unit assumption. It's only when you start paying them salaries or paying them an advance or whatever you give them that you start recording the transactions. Now, transactions could be external or internal. When we talk about internal transactions, we talk about the use of inventory, the use of supplies, etc. External transactions, they deal with outside parties such as the company and its suppliers or customers, banks, government agencies, etc. Now, every transaction has a dual effect. And what do we mean by dual effect? It means that it has to affect at least two accounts in the accounting equation. If you have an increase in an asset, that should be basically counterbalanced by either an increase in liabilities or an increase in stockholders' equity could be, or simply a decrease in another asset. Take, for example, buying an equipment for cash. So if you buy a computer for $1,000, your cash will go down, that's an asset, and your equipment, which is also an asset, will go up. Those two, remember that at all times the accounting equation must hold. In other words, assets must always be equal to liabilities and stockholders' equity. Now, the criterion whether to record a transaction or not, it simply depends on whether the financial position of the company has changed. For example, the assets accounts, liabilities, or owner's equity, did these accounts change or not? If they have changed, you record them. If they have not changed, we do not record them in order not to violate the monetary unit assumption. So let's take those for example. Those are events. For example, if we purchase a truck, do we record it or not? Well, purchasing a truck will increase equipment and will, if we buy it for cash, it will decrease cash. So it does affect the accounts, and in this case, we record it. In this case, we record it. Now, when we hire an employee, we do not record it. Like we mentioned before, hiring the employee does not affect does not change the financial position of the company. It's when we start paying the employee that this will change. But the actual hiring, the event of hiring an employee, it is not recorded. When we sign a lease agreement with a landlord, for example, again, the same thing. We do not record that one. Now, when we start paying mortgage, yes, that one is to be recorded because it will change it will have an effect on the accounts. So whenever we think about analyzing a transaction, because of the changes that happen to stockholders' equity, it is very important to keep track of what caused this change. Was it, for example, coming from investment or from revenues? And therefore, we need to analyze each transaction based on its effect on all the accounts that are involved in that transaction. And like we mentioned before, every transaction can affect either side of the equation or both sides sometimes. For example, if you buy cash, if you buy again a truck for cash, then only the assets are affected. We have an increase in equipment and decrease in cash. Same thing applies for supplies. On the other hand, if we buy the truck on account, that would be a loan, or basically, or that would be a liability. In this case, we have an increase in equipment, which is an asset account, and a decrease, and also an increase in accounts payable, which is a liability. So we need to keep in mind that the total assets must always be equal to total liabilities and stockholders' equity at all times. Now we will be analyzing some transactions in order to identify the accounts that were involved and how these accounts have changed. So when we analyze a transaction, the first thing we need to do is to identify those accounts that are involved in this transaction, and then we need to see how they changed. Did they increase or decrease? So the first transaction is where Mr. John Smith opened a law firm during the month of October that he names Smithco. On October 1st, he invests $10,000 cash in exchange of common stock. So the company, Smithco, received cash in the amount of $10,000, and which is to mean that the cash has increased by $10,000. So we add $10,000 to cash, and then that was in return of common stocks. Now, common stock is the investment in the company. And in this case, the amount that was invested in the company increased by $10,000. We need to also write the explanation regarding why stockholders' equity has changed. It is very important to keep track of why this change has occurred in order to know whether this is coming from revenues or whether it was coming from investments. At the same thing applies for expenses, to know basically what kind of expenses we are paying. So here we have issued stock, common stock. Now, the second transaction is where Smithco purchases supplies for $500 on account. So in this case, supplies, which is an asset account, has increased by $500. But we did not pay it directly. And whenever we say we paid it on that it was purchased on account, it means that this is an increased liability. So in this case, the asset account supplies has increased by $500, and the liability accounts payable has also increased by $500. Here the explanation would be purchased supplies on account. And here what happened is that we have more assets, but at the same time we have also our liabilities have increased. As you remember, the two sides of the equation must be equal at all times. And if you look now, those two sides of the equation here are equal to this. They are equal. So the asset side is equal to the liabilities plus stockholders' equity. Now, in the third transaction, Smithco purchases equipment for $6,000 with cash. So the asset account equipment has increased. Now the company has more equipment, but their cash decreased by 6,000. So in this case, we have plus 6,000 for equipment minus 6,000 for cash. And as you can see in this case, the liabilities and stockholders' equity side, the right side of the equation, was not affected. So we had an increase in one asset and a decrease in the second one. Now the fourth transaction says that Smithco receives $4,800 cash from their clients in return of legal services. What happened here is that Smithco provided services to their clients for cash. So what are the accounts that were involved? First, we have cash was involved because they received cash, and then in return of legal services. So basically what we have here is cash has increased by 4,800 and revenues have also increased by 4,800. So those services that were provided are actually revenues that the company has earned. And as we said, we need to enter the explanation to know why stockholders' equity has changed. So we put here that that was service revenues. Once again, the two sides of the equation are equal. Now, Smithco receives a bill of $300 from ATCO for advertising services, but does not pay it until later. So they did receive the service from ATCO. Think about it as ATCO posted an announcement for them. However, rather than paying them directly in cash, they don't pay it now. So what does it become? We have, in this case, an increase in liabilities because now the company owes ATCO $300. And because they received services, they have also, this will also cause a decrease in stockholders' equity. Why? Because this is an advertising expense. So this expense will decrease stockholders' equity. So we have now 300 plus 300 liabilities, and we have minus 300 expenses. That would be advertising expense. In the sixth transaction, Smithco provides John Doe, one of their customers, with legal services for $2,400, but only receives $1,600 in cash, and the balance of $800 is billed on account. Once again, we need to identify the accounts that were involved. We know that they provided services, and that would be service revenue. And they also received $1,600, $800 that are involved. Cash increased by revenue Smithco of $800 and 100 that are involved in this cash and as well as rent expense and salaries and wages expense. So what happened to cash? Cash has decreased by $800 because they paid those expenses. So cash has decreased by the total of 800 plus 1100, which is minus 1900 for cash. And then we have rent expense for we have rent expense minus 800 and salaries minus 1100. Once again, the total, and here we have rent expense and salaries and wages expense. Once again, the two sides of the equation are also equal. Smithco pays Atco's bill of $300 in cash. So that was that $300 bill that was here. Now, here in this case, what we're doing is we are paying a debt. Atco is not providing an additional service. As a result, we don't have a new expense. It's not an advertising expense that was provided in transaction 5. Here, on the other hand, all we're doing is we are paying a debt to Atco in the amount of $300. So what happens here? Our cash decreases by $300 and our liabilities also decrease by $300, and that would be for liabilities payment. In the 9th transaction, Smithco receives from John Doe $400 in cash. This is basically to pay part of the debt that they had from from transaction 6. So this is when Smithco provided them with services, and rather than paying them in cash the full amount, they paid them $1,600 in cash, and the remaining $800 was as a debt basically to John Doe. So from John Doe. So basically here Smithco had accounts receivable of $800. Now John Doe is paying back part of their debt to Smithco, and this is why we have here the cash account of Smithco will increase by $400, and their accounts receivable, this is how much money their customers owe Smithco, it decreases by $400. Basically, John Doe, they used to owe them $800. Now they owe Smithco only $400. And this is collection of accounts receivable. The 10th transaction, in the 10th transaction, Smithco pays its shareholders a cash dividend of $900. So they decide to pay part of the money to their shareholders in the amount of $900 cash. So what are the accounts that are involved? In this case, the accounts that are involved are cash and dividends. What happens to cash in this case? Cash will decrease by $900, and dividends will be reducing stockholders' equity by $900. So basically we have cash decreases by 900, stockholder dividends will decrease stockholders equity by 900, and this is cash dividends. Now if we look at the summary of all the transactions that we had, we can see that the two sides of the equation are equal, and they must be equal at all times. In this part, and this is the last part of chapter 1, we will be talking about the financial statements. Basically, under GAAP, companies are required to publish 4 main financial statements, and those are simply income statement, retained earnings statement, the balance sheet, and the statement of cash flows. We will talk about them now, and we will be talking about them during the semester. Most of the time we'll be talking about the first 3 of them. The last one, statement of cash flows, we will be discussing that in details in a later chapter during the semester. So to start, the first one that we always start with is the income statement. And the income statement reports the success or profitability of the company's operations over a specific period of time. Basically, it lists the revenues and the expenses of the company. It's all the revenues minus all the expenses, and that would give us the net income or net loss. In cases where we have more revenues than expenses, we'll end up with net income. When we have more expenses than revenues, we have a net loss. Now, as you can see here, the first line is always the name of the company. The second one is the name of the statement. It's which statement we are talking about. The last one states the period of time for which this income statement was prepared. Those are the 3 lines that are at the beginning. And as we mentioned, the income statement is prepared over a certain period of time, whether it was a month, a year, a quarter. It always said, if it were, for example, a year, it would say for the year ended 2013. Once we have prepared the income statement, we can take advantage of the number here in order to add it to the retained earning statement and to prepare the retained earning statement. Basically, the retained earning statement, what it reports is the changes in retained earnings for a specific period of time. This period of time is usually the same as the period that was covered by the income statement, and this is why we are able to take the net income that was calculated in the income statement, and we use it in order to prepare the retained earnings statement. The way we do it is we start with the beginning balance, retained earnings beginning balance, we add net income, we subtract the dividend, and then we end up with the retained earnings at the ending period. Now, once again, we have here the name of the company, the statement, and the period that was covered. This is, as you can see, is the same as a period that was covered in the income statement. Now, after that, we get to the balance sheet. So the number here, the retained earnings ending balance, we can use it in order to prepare the stockholders' equity section and the balance sheet. So the balance sheet is also called the statement of financial position, and it's like a snapshot of the accounts of the balances of these accounts at a specific point in time. So basically this is not for a period of time, it's for a specific date. And this is why, as you can see here, it says October 31st. It doesn't say month ended October 31st or something like that. And basically it is a list of these accounts that are on the in the accounting equation. We start with assets, so we always start with assets. The second, and then we include the liabilities and stockholders' equity. And as you can see here, the total assets must always be equal to total liabilities and stockholders' equity. Now, this number here, the balance in cash, is the same. It is supposed to be the same as the cash at the end of the period. That is basically that we find at the end of the statement of cash flows. The statement of cash flows basically describes the cash inflows and cash outflow. Those are cash receipts and cash payments, and we only care in this case about cash receipts and cash payments. And it helps us answer questions such as, for example, who did we pay for, where did the money come from, etc. At this point in the course, we need to know that the statement of cash flows basically has three parts. The first one is net. The first part is cash flows from operating activities. The second one is cash flow from investing activities. And the third one is cash flow from financing activities. We will be covering the statement of cash flows in more details at the end of this course. Now we will solve a couple of problems that will help us better understand what we have been covering so far in this chapter. So the first problem is a very simple one. It is asking us to calculate the total assets of the company based on a list of accounts and their balances. When we are asked to do something like that, we check them one by one to see whether they are assets, liabilities, or stockholders' equity accounts. So in this case, we start by looking at the first one. The first one is advertising expenses. Now, are these advertising expenses? Is it an asset account? No, this is stockholders' equity account, so we do not count it. Cash? Yes, it is. Accounts payable? It's liability. Rent expense? Stockholders' equity account. Service revenue? Stockholders' equity account. Supplies? That's an asset. Dividends, stockholders' equities account. Then we have accounts receivable and equipment. Those are assets. So total assets would be equal to 7,700 plus 500 plus 400 plus 6,000, and that would be equal to 14,600. That's C. Now this problem is or might be similar to the kind of problems that you might get in the exam. This problem is a typical exam problem where they would ask you to calculate the net income or the net loss. And the way to think about it, we should think about it in a general way. So first, we need to start thinking about stockholders' equity and break it down into its components. So stockholders' equity end of 2014 is equal to common stocks and 2014 plus retained earnings ending 2014. Now we can think about common stocks at the end of 2014 as common stocks, the value of common stocks at the beginning of 2014, and whatever common stocks was issued in 2014. So this one would be equal to common stocks beginning 2014 plus common stocks during the year 2014. Retained earnings, on the other hand, can be calculated or broken down in the same way that we saw in the retained earnings statement. So the retained earnings statement would say that it's retained earnings beginning balance plus you add net income less dividend of that year. Those three are equal to the retained earnings ending balance, and those two are equal to the common stock ending balance. Now let's rearrange those numbers a little bit. So let's have here common stock beginning 2014 plus retained earnings beginning 2014, and then we continue. We put the remaining ones plus common stock in 2014 plus net income minus dividends. Now those two are equal to stockholders' equity beginning 2014 plus common stocks 2014 plus net income minus dividend, and that would be stockholders' equity equaling 2014. So if we plug the numbers here, let's plug in the numbers, that would give us 360,000 are equal to 270,000 plus 0, as they did not tell us anything about any stocks that were issued during this year, plus net income minus dividend, which was 30,000. That would give us net income is equal to 120,000, and that would be C. Now this problem also can be solved using the same equation that we used in the previous problem. Here they are asking us to calculate the dividends. So on October 1st, Smithco reported stockholders' equity of 110,000. During the month of October, the company issued common stock of 15,000 and declared a net loss of 8,000. If stockholders' equity at October 31st totals 110,000, what amount of dividends were paid during the month? So we start by writing the same equation. That was stockholders' equity ending at the end of October is equal to stockholders' equity beginning of October plus any common stock that was issued during October minus net loss, because we have here a net loss, minus dividends. Let's plug in the numbers. We have 110 thousand is equal to 110,000 plus 15, that 15,000 of common stock minus net loss of 8,000 minus dividend. So if we move dividend to the side, it is equal to 100,000 minus 110,000 plus 15,000 minus 8,000, and the answer would be 7,000. That would be D. As you can see, it is very easy to understand. Once we understand how this formula was derived, we can easily use it to calculate common stocks that were issued during that month. We can use it to calculate net income or net loss during that month.